Welcome everyone to another episode of How to Make Money in Stocks with Investors Business Daily. We want to let you know that the iTunes podcast version of this is now available, so you can subscribe to that and download it each week. Listen on your iPad, your iPod, your iPhone, whatever you want to do. And also, please leave us a review, give us a comment, and let us know how we're doing.
Now, we're going to talk about this trendless market that we've had. And we've had this trendless market for a while.
Yes.
As Juan Arancibia pointed out in the big picture column, we are not rising enough to be in a solid uptrend, and we're not pulling back enough to be into a correction. So that's one of the things we're going to talk about on the show this week.
It's a frustrating market, and that's what we're going to deal with. Now, we're also going to introduce a couple of new segments to the show that we'll do from time to time. One is a super stock review. We'll go back and look at a past big winner.
These will be fun.
It will be fun,
really
so that it'll help us find the next big winners. And we'll also do the Teachable Market Moment, where we'll take a look at something that happened in the market recently and what we can learn from that. As you can see, someone is missing from this picture. Amy's in Portland Saturday for a leaderboard summit, so it's just me for this segment. But we did pre-record the rest of the show, so she'll be rejoining us in a few minutes. Now, there's no getting around it. This continues to be a fickle and frustrating market and a fairly unforgiving earnings season. But let's start with a look at how the indexes closed for the week. We'll get into the recent market action in more detail in the next segment, but you can see how the NASDAQ found support at the 50-day line on Monday, but after Thursday's sell-off, it closed the week below it. Now here's a daily chart for the S&P 500. As you track both indexes, you can look at how the 50-day moving average line is like a first line of defense. Both the NASDAQ and the S&P failed to find support at that benchmark, and the S&P is now testing its second line of defense, the 200-day moving average. On Friday, it fell below that line during the day, but managed to close above it. Now, given the up and down pogo stick type action that both the NASDAQ and the S&P have shown recently, we'll just have to wait and see what next week brings. Apple has been a drag on the NASDAQ since Apple makes up about 7% of the tech-heavy index. And as you can see, the maker of the iPhone has fallen from grace. It crashed below its 50-day line in July and fell below the 200-day line on Monday. And in Friday's big picture column, Paul Whitfield listed other sharp sell-offs that we've seen in the market recently. These came on a reaction to, or perhaps in the aftermath of, each company's latest earnings report. We saw Tableau Software drop 11% on July 29th. Corvo dropped 14% the next day, and the next day after that, Outerwall dropped 13%. That's the company behind the Redbox DVD kiosks that you see outside all the supermarkets. Criteo dropped 14% August 4th, and Disney, which we'll talk about a little bit later in the show, dropped 9% on August 5th. It's not surprising that in this environment, we've seen a lot of breakouts that stumble and stall, and we have seen that. But some leaders like Skechers, Netflix, Alaska Air, Icon, and others continue to show strength. However, it's certainly an environment where you want to be very picky about making any new buys and keep a very close eye on any stock that you still own. Arista Networks is an example of a stock that is near a buy point, and as a member of the IBD 50 and the sector leaders screen, it's one you might want to have on your watch list. It makes cloud networking gear that helps tech giants like Facebook and Microsoft manage the flow of data between their internet users and their data centers. Now, I covered Arista in Thursday's IBD stock analysis, and you can see how it's found support at the 10-week line as it's formed a handle within this cup with handle. It beat on earnings when it reported after the close on Thursday, and it had a bit of a wild ride on Friday, but managed to close about 3% higher. Now, it may end up breaking out, but as we mentioned on last week's show, few recent breakouts have yielded strong gains, and many have stalled or even pulled back. So with any stock, you want to proceed with caution in this market and make sure you stick to sound buy and sell rules. And of course, earnings season is still rolling along, and on deck for next week we have Zebra Tech, CyberArk, Alibaba, and many more. You can check the earnings calendar in IBD's Monday edition for more names. As anyone who has been watching the market this year knows, there's been a lot of up and down seesaw action in the indexes. Now, generally speaking, the NASDAQ has performed better than the S&P 500, but it, of course, has had its own share of volatility. So today we're going to talk about some ways that the two indexes are a little bit out of sync with each other and what that tells you about the market. Now, we also want to note here, too, that on Friday, Amy is traveling, so we're recording this after the close on Thursday. Of course, it's been a volatile market, so Friday could bring some changes.
Who knows? So as you can see on the daily chart of the S&P, the week of July 21st, the S&P sold off with increasing pink or red volume, and some of that was due to falling commodities prices. This index has more of those names on it. So the distribution count has been higher on the S&P than it has been on the NASDAQ. Now, distribution refers to heavy volume selling. Okay, that's just a day of heavy volume selling. And what it shows you, the pros are in there heading for the exits.
But the S&P did seem to find support around the 200-day line, and then on July 28th, it made a nice move up, and that was on above average volume. And then it recaptured its 50-day line.
But didn't last long.
That did not last long at all. And of course, we went right back into that roller coaster market on Thursday when it sold off sharply.
Now, the NASDAQ also suffered high volume selling, the same as the S&P the week of July 21st. And it fell down to the 50-day, but it regained the line, fell below it, on higher volume. And, you can get kind of faked out in this market. We saw a couple of days, we thought we saw some conviction by the institutional investor because we had some higher volume upside days. But Thursday, once again, the NASDAQ fell down beneath the 50-day moving average.
Now, earlier this week, in the big picture column, Juan Carlos Arancibia summed up the market pretty well when he said that the composite has been the better index this year, but the disparity in the distribution days reflects the perplexing nature of the market. The main indexes continue a pattern of short-term advances and declines, never enough to cause a correction or enough to climb more than a few weeks.
So these short-term advances and declines that Juan talks about have given us this yo-yo market. They're not big enough to get us moving. We're not really trending higher. Right. And it's not enough on the downside to give us a correction, even a shallow one. So this just shows the indecision by the pros. They're not committing really in any direction as of yet.
And as we said earlier, the NASDAQ has been the better performing index. Now the question has been, is the NASDAQ going to pull up the S&P 500 or is the S&P 500 going to pull down the NASDAQ? Well, as of the action on Thursday, it looked like the S&P was going to do the pulling down. And it just reflects the hesitation and the uncertainty on the part of large investors. And that's also reflected in the fairly large number of stalled breakouts that we've seen in the market recently.
And one example of this is Edwards Life Sciences. It's just a very good example. Stock broke out and it just drifted lower. So it broke out July the 7th, but volume was only 13% above average. That's a pretty tepid breakout. However, it gapped up July 13th and volume rose 38%. Now, we usually look for a minimum of 40% or greater on the breakout, showing professional buying. But in the case of Edwards Life Sciences, volume was a little bit lacking.
I covered Edwards Life Sciences in the June 26th IBD stock analysis as it was forming a handle. And it had shown heavy volume in the right side of the base, but as Amy noted, volume wasn't as high as you'd like to see on the day that it actually broke out. And it has pulled back, as many stocks have done, since that time. And that is, of course, very frustrating. Now, it had been finding support right above the buy point, but that changed on Thursday when it fell below it, and it came all the way down to test that 50-day line. Now, depending on what your target sell price is for that stock, if you bought it on that recent breakout, you may have been shaken out.
Well, Edwards Life Sciences reported earnings July 28th after hours, and they beat on earnings. Mm-hmm. They also beat on sales, and their outlook was good. But the stock pulled
back. Not enough.
and sometimes, you know what, you really are not going to know at the time.
Right.
But, this is a period of time where you say, you know what, you just have to accept what the chart is telling you. And since that time, actually, Edwards Life Sciences has drifted lower, as Matt pointed out.
And that is why in this type of market environment, you want to keep any new buys on a tight leash and make sure that you do have an exit plan in place to cap any potential losses.
So let's take a look at Texas Roadhouse. Now this is fun. I like this one. They have the roadkill steak, Matt.
That's right.
They have a sense of humor, this company does. And this is another example of a stock that pulled back after its breakout. And the reason, once again, was, ta-da, drum roll, earnings. All right, Texas Roadhouse broke above a price consolidation July 13th and closed just below the pivot of 38.52. And then it pulled back to the 50-day line but made a nice move higher July 29th and rose 51%. Then August the 3rd, Texas Roadhouse moved higher on big volume that was 324% higher than average. Now this was prior to its earnings report. This was on the day that it was due to report after the close. Now, what do you think happened in after hours, Matt?
Let's find out.
After hours trading, the stock missed Wall Street's expectations, and it sold off on high volume. But it, too, found support and bounced off the lows of the session.
It is a good example of how a stock may look great going into earnings, but then it reports, it misses, and it takes a haircut. Now, look at what Texas Roadhouse looked like before it broke out. The relative strength line had shot into new high ground, which is a bullish sign. So things were looking good, and as Amy noted, then it still got whacked. So this is what we mean by saying that there have been a lot of stalled breakouts, challenging breakouts recently. But on a more positive note, Texas Roadhouse did find support at the 50-day line, and it closed just above the buy point on Thursday.
So for those of you who have been buying breakouts lately and you've experienced some stalling action, you're not alone.
Definitely not. So let's take a quick break, and we'll come back and see what lessons we can learn from a former super stock that you may be very familiar with.
How would you like an edge that helps you pick winning stocks faster? An edge that is proven to outperform the S&P 500 by 76% since inception, and that you can take advantage of today without spending a dime. More on that in a minute. Each day, our top market team at Investors Business Daily scans our proprietary stock lists and screens to find superior stocks with the most potential for big gains. They analyze these stocks every step of the way to show you basis, buy points, sell signals, and the right time to take profits. It's about as close to hold your hand investing as you can get. Introducing Leaderboard by Investors Business Daily. For a limited time, you can try all of the premium features Leaderboard has to offer for a full 14 days at absolutely no cost to you. You'll receive unlimited access to all of the time-saving research, powerful investing tools, the leaders list, cut list, and expert analysis you need to develop a winning investing strategy. And it's all 100% free for your first 14 days.
This is a new segment that we're going to do from time to time. And the idea is to look at a past big winner so that you know what to look for when you start hunting for the next crop of big winning stocks. Now, market history clearly shows us that the top performing stocks share certain traits just before they start to run higher. So you want to look for stocks that have those same traits today.
Well, this is called our Super Stock Review. Now, some of you may remember that IBD chairman and founder Bill O'Neill had a Wednesday article in the paper each week reviewing some of these great market winners. Priceline was in Bill's article. It was called How to Find and Own America's Greatest Opportunities. So we are going to look at Priceline. This stock had its IPO launch in March of 1999, the roaring 99s.
Yep.
Initially, its price collapsed, though, in the 2000 major market decline.
With pretty much everyone else?
With everybody else.
Right.
But its services were so unique, it led up to a dramatic earnings growth rate from 2001 up to its first buy point in 2006 and beyond.
And one thing that these best stocks have in common is that they typically form a base while the overall market is in a correction, and then they break out in the early stages of a new uptrend. And as Bill pointed out in that article, that's exactly what Priceline did. It formed this 15-week cup with handle, and that was created during a 3-month correction. Then in 2006, we had a new uptrend, and soon after that, Priceline broke out.
Now, Priceline completed its pattern and broke out on the 8th week of a new market uptrend. A lot of your biggest winners, as we've said, Matt, will come out in the first couple weeks up to the first 8 weeks of a really hot new bull market or a new uptrend.
And it could be in the first couple of days. It could be the same day.
Sure. So this stock was up 250% in 1 year and 11 weeks. So as Bill says in his article, make sure you have solid rules for the very best stocks, and that include the vital fundamentals and the chart patterns, as well as making sure that you're staying in sync with the overall market trend. Something that I like that Bill put in here that I think is really great, he says, don't ever be discouraged and give up. It's a wonderful lesson from Bill, no matter how difficult the market is, as it is right now. So we'll start here by looking at the chart, and this made a beautiful move right along the 10-week line. This is what a lot of big winners have in common.
So let's talk about what did Priceline have in place when it launched that move. And it's something you see in most of the big winning stocks. That's the point here. This happens again and again. Number one, it formed a base during a correction. Number two, it broke out in the beginning stages of a new uptrend. And number three, it had strong fundamentals. Look at the annual earnings growth rate. It was 98%. It had a 20% return on equity, and it had 3/4 of rising fund ownership. And that's actually reflected in the chart.
Now also take a look at the enormous spikes in volume, which have arrows pointing to them. And you can see visually how much buying power was coming into the stock week after week as it made its massive move higher. The red spikes in volume are smaller than the black spikes, showing more accumulation than distribution.
Now, of course, we all remember 2008 and the financial crisis and the bear market. Now, of course, Priceline, like most stocks, also pulled back fairly sharply. But then it did well when the new bull started in 2009. And it went on to form a base while the overall market was showing weakness. And then once when a new uptrend got underway, Priceline broke out again.
And what was happening with Priceline at the time? Well, they were running some really clever and funny commercials with William Shatner around 2007. And since then, they evolved over time as the Captain Kirk turned into the negotiator for Priceline.
And also in 2005, they bought Booking.com, and that led to a huge growth in overseas business for them, especially in Europe, where it was still relatively new to start doing travel booking online. And because of that, from 2006 to 2010, Priceline's overseas revenue grew at a compounded growth rate of 68%. Now, that's big. And during that same period, domestic growth was around 15%.
And what a base it was. This was 37% deep. I remember this one, Matt. This was not really a pretty looking base.
It was quite deep.
It was pretty deep. But the company came out with earnings and the stock soared higher. Now, where could you have found it in IBD? Well, it was in the IBD 100, which is now the IBD 50 screen. But first, you needed to be in sync with the overall market. So what was the outlook in our paper? Well, the market pulse said the market was in an uptrend, so this was a time when you were now actively looking for stocks for your watch list. And the IBD 50 mini chart right here said Priceline was number 48, and right underneath the mini chart it said forming a potential handle, the base was a bit deep, and it lacks accumulation. That's kind of critical right here because after it was starting to break out, the buying power and the accumulation did come into this. And that was because of a strong earnings report.
So let's go back to what we were just talking about a little bit earlier again. Number one, Priceline was working on a base, and then when the market came back into an uptrend, it broke out. And it did have, like you said, the fundamentals that we look for in a winning stock. It had a 53% annual EPS growth rate. The last quarter's earnings growth was 56%, not too shabby, and the return on equity was 42%. So that's what was in place for Priceline when it reported another round of earnings, and it bolted out of that base on huge volume.
And let's go back to the current market. What happened recently, Matt? Priceline beat earnings expectations this week. It broke out of a cup with handle base and zoomed 5% higher on volume that was 243% above average.
So let's take a quick break, and then we're going to come back and do another news segment called the Teachable Market Moment.
For this week's Teachable Market Moment, we want to revisit the idea of having a game plan for stocks that you own going into earnings. And Disney's a great example this week of why that is so important.
Now, Disney reported after the close on August 4th, but let's take a look at the lead up to that Q2 report. You can see how it broke out in June, and it was making a nice climb ahead of that earnings report.
It was looking absolutely fabulous. They had a great first quarter with Avengers Age of Ultron. It amassed $1.4 billion worldwide, making it the 6th highest grossing movie of all time. Now, based, as Matt said, on that nice tight chart action, plus the fact that it was just above a 3 weeks tight pattern, you might have been really excited about this stock going into earnings.
Of course, how you feel doesn't really
matter.
Bottom line, nobody cares, unfortunately. But you have to build a plan not based on your feelings, but on how the market actually works. And if you had bought back in June, you would have been up around 7%, give or take, before Disney reported. That is not a huge profit cushion, and you need to have a defensive plan in place ahead of the earnings report.
Now, the highly anticipated Star Wars The Force Awakens comes out this Christmas. You going to go see it, Matt?
Sure.
Yeah, it's got the original cast. We have Harrison Ford, Mark Hamill, Carrie Fisher. I was really young when the first one came out. It's amazing that we're going to go back in time with these stars.
Right.
The Star Wars franchise brought in more than $4 billion, and Star Wars toys have sold more than $12 billion. That's a lot of little toys.
It is. Now, all of that sounds really promising, right? And like you said before, you may be getting very excited ahead of the earnings, but you have to stay disciplined and set a defensive sell plan ahead of the earnings report. One thing you want to do is set a potential target sell price just in case it doesn't work out and the stock goes down. And you can also set a stop with your broker if you want to go that route. But the bottom line is you want to have a plan to cap your potential losses.
Absolutely. Now, that nice tight chart action was really broken this week as, the stock gapped down. It lost 9%. It lost more on Thursday. Disney actually beat on earnings, but it missed on revenue. They've had difficulty. The prices are pretty high at their theme land parks. And Disneyland Paris really didn't do as well as was anticipated. They also had some subscriber losses at ESPN.
Now, because of the way that Disney gapped down, you might not have gotten out at the exact price that you wanted to. And also, maybe you've been holding Disney for a long time and you're sitting on a very big gain, then it probably did not trigger your own target sell price. But the point is, you always want to have a potential exit plan just in case. And that's especially true if you bought more recently and you're sitting on only a small profit.
We want to thank all of you that sent in some nice comments for our first video attempt last week. And if you have more segment ideas, please do email us.
And you can always give us feedback via iTunes as well. So the podcast is now available. You can subscribe there, download it, leave a comment, and rate it as well. And you can have a direct link to that. You'll find a direct link to that at investors.com/investingshow.
Okay, see you next week, everybody.